Hey guys, so today's session I made $10,000 trading SPY, a very simple and effective strategy. I'm going to show you one, what my ideology was behind the trade, two, how I trailed it out to make a lot more than I would have if I simply just took profit and went away. And then three, we're going to talk about why I used a contract recycling approach, what it is, and how I use that idea to make more money in the trade than I would have if I just stuck to the same contracts and rode the whole move down. So that's what we're gonna do today. The first thing I want to talk about, obviously, of course, is we're going to dive right into the charts. I'm gonna show you guys everything I was looking at 8:30 a.m. Eastern Standard Time. And the first video I want to show you is my thought process from the morning stream at 8:30 a.m. that we do every morning on YouTube. Go through that first, then we're gonna dive back here with the charts. We're gonna go over the actual strategy behind it on the entry. Is I would be saying this: don't short back into 520. This is still a very massive hold spot from last week, but if the market does lose 520, you could look for failures and a short move back down. That, I think, would be top watch for shorts this week. Is if we do lose 520, we can look for shorts, we can look for puts, we can look for the whole move down back into 510, back into 496, back into 480, right? 510 being the first demand to watch out for down below. That doesn't mean we can short yet, though, right? Obviously, we are still holding demand here. As much as I want to say that we look weak, right? We are looking weak. We are gapping down, but we're gapping down back into major support here. This is still major technical support. We could simply do this today, right? But what would make us want to go long? So if you were long off of the Wednesday session, Wednesday lows, and you longed off 520, congratulations, it was a good long. But today's session, it's not about that. What it's about is understanding, hey, if we're in the zone between 520 and Friday's lows, 524, this is my area of saying I don't really want to be a participant here. Where I want to be participating is going to be a break and hold above 524, above that Friday's lows. That would be a bullish move. This would be a bearish move. And those are the only players I would watch on SPY right now, right? It would either be, hey, we reclaim Friday's lows, right? We start ripping higher, we can target back to 530, I can look for that for a long side, or the market loses demand and we lose 520 and we go back down to 510. The reason why I say this is because I don't think that the zone between 520 and 524 is going to be a very pleasing zone to trade in, right? I don't think this is going to be a very nice zone. I think it's going to sort of stay choppy, stay consolidated, because the market needs to understand the direction it wants to set this week. Are we going to be setting a bullish direction or are we setting a bearish direction to start the month? All right, so now we're back at the charts. I want to talk to you guys about the strategy behind it. So now you know the analysis. The analysis was, hey, let's look for shorts under 520. 520 is holding bullish. If 520 loses, bearish. What makes us go short? And so this is where things become interesting, right? We know our level is 520. I think everybody knows our level is 520. But why is 520 so important? 520 was so important because we knew that it was a pivot point. It was a moment where bulls are going to be stopped out. It was the pressure point in the market. And a lot of times, if you're trading SPY or trading any ticker in general, you're looking for those pressure points. You're looking for the moments where you have a shift in trend, a shift in bull to bear or bear to bull. That moment, that precise moment, is oftentimes the most optimal of entries because you know if I short 520, my risk is maybe $1 and my reward is 10 times that, $10. Now, most people will never see the 10R trade. In fact, I very rarely do. I'm not going to sit here and tell you guys I always get 10R. I never do that. In fact, usually I get 1R or 2R. But there are some times when you have the optimal point because you're in at that flick, at the switch between bull and bear. If you get long or short at that flip, then you obviously have what is considered the best entry because again, you're getting in at the moment it shifts from bear to bull or bull to bear. In this case, it was a bear to bull scenario. 520 was the pressure point. We lost 520. We gave a not so clean candle. Then this candle right here at 940, we produced the first bearish close under 520. I then went short at 520. My stop loss would have been right here, that candle high. The optimal stop loss technically would just have been 520, but I wanted to give it a little bit of volatility. So I gave it to 520.6 as my stop loss. So I entered there, stop loss there, and I looked for the first move back into low day, which is in this case here for first trim. So we got our first trim as we structured lower here at 950, structured lower at 950. I sold about 40% of my position, even 50% of my position, right? Because again, at that point, I'm at 1R. My risk in this scenario would have very simply have been what? A move above 520.6. My entry is somewhere at 520, around 519.8. And my first trim was at the break of low day here at 518.7. That means that my risk is actually just being perfectly met by first trim. This is very important. Anytime you're in a trade and you want to know where do I take first trims, you should be taking trims at a bare minimum of your 1R. In this case, I took it somewhere in the ballpark of 1R. Options are more volatile and a little bit more emotional than, say, futures or equity. So even though it says I'm making more on the return here, the green box, than my risk, the red box, it is still about a 1-to-1 here. Why? Because my first trim happened at about 11%. My risk would have been at around 11% as well. Options are more volatile, are more emotional contracts. Therefore, I would have lost more even though I was risking less dollar amount. And the second thing I did basically was trust my EMAs. A lot of my strategy comes down to trusting EMAs. If I have the direction right on a trend-based entry, all I need to do now is hold the position as long as it's holding the EMA, okay? So in this case, it was either use the 5 EMA or the 8 EMA or the 13 EMA. I chose the 8 EMA. The 8 EMA was my level. So as long as you're holding under the 8 EMA, which is the red cloud here, I was maintaining my position and taking trims into every failure lower, every push down in the market. Because again, under 520, we should see it move back into 510, but it doesn't necessarily mean it has to happen in one trend move down. You may see some ebbs and flows and ebbs and flows and ebbs and flows until 510. Again, in theory, it would make sense to hold the 510, but in practice, it becomes much more difficult to do that. That's why I rely on something very basic to keep me in trades. Entering a trade off of a pressure point off a level, exiting a trade off of an EMA. This is what allows me to keep trades for a much longer time. So I end up going short here again at that same level, 945, 940 candle. Got the move into lows here, first trim, took more trims there, more trims here, and caught the whole move essentially into 510 into close today. Why? Because we maintained under the 8 EMA with the exception of one moment, which normally would have stopped me out, but I held because I had so few contracts left that I caught the move back down to 510. But again, how did this trade become a multiple 100% trade? Was it because I knew we were going to go to 520 to 510 today in one day? No, I did not know that. From a level standpoint, yes, it was possible, but it doesn't mean it's going to happen in one day, in one sitting, right? It may take a few days to get to 510. Today's session was just simply about trend. It was simply about getting at the right level, using the EMA to stay in the trade, and it goes in your favor to your level. There is nothing beautiful or magical that we knew was happening to the market today, which said, hey, we're going to go to 510 today. No, it was just getting off a level, use an EMA to hold your position, trail out into every move lower, and maybe you get your level. And if you do, you full sell there. So the next thing I want to show you guys is about our contracts. Now, in my P&L, you saw I had taken about 4 or 5 different contracts. And the reason why I did that was because by the time we had hit 515 in the market, I full sold out of my entire 515 puts, my 1DTE 515 puts, and I opted for out of the money contracts. The reason why I had done this is because I realized something, that if I'm in a trade for a longer period of time, in this case, a trade that is holding below my EMAs, holding below my levels, and I'm trying to trail as much as possible. Let's just say I had a $10,000 position today on SPY, right, at 940, okay? I'm in at 10K at 940. I should be, in theory, at 515 on SPY. I should probably be out about 70% of my trade. So I should have $3,000 maximum left over in this trade. And I could choose to hold a few more expensive 515 puts, or instead I could opt for cheaper contracts and buy more of those cheaper contracts that have a higher collective delta value by shifting all those 515 puts to say 512 puts or 513 puts. The reason why I do this is because of something known as delta value. The closer to the money, the larger the delta value. And you may be wondering, Brett, if I'm saying that, why would you choose to go to cheaper contracts which have less delta value? But remember I said something. Collective delta value is very important. So think of it like this. If the 515 put has a delta value of $72, that means that every dollar move of the underlying, in this case SPY, those contracts are going to move $72, which in this case is 10%, right? It's about 10%. So every dollar move on SPY, you're getting a 10% return on your investment. But if you look at a option contract that is a bit cheaper and inherently has less of a delta value, let's just say, for example, these 507 puts. These 507 puts have a delta value of 0.43. 0.43 divided by 3.46 is about 12.5%. So that means that every dollar move on SPY is a 12.5% move in these option contracts. And what we've just determined is that out of the money contracts, of course, are going to move more percent wise than in the money contracts. So, from a delta value perspective, on the collective, not on the individual contract, but as a collective, the out of the money contracts will move better. So, that is why I opted for the cheaper 512 puts. I shifted all out of the 515 puts. I took that same $3,000 into the 512 puts, okay, into the 512 puts, and in this case, bought a whole bunch more contracts and used the same stop loss I was using before. In this case, I was using simply the AEMA and I rode the whole trade down lower. Now you may wonder, Brett, if I took a loss on that trade, does that mean I just took two different trades? No, this is still the same trade, right? You can argue it's a different trade, but it's not a different trade. This is still the same trade, the same setup, just taking different contracts to capitalize on that move a bit better. In the money contracts are very powerful, but they're not going to be as exponential as, say, an out of the money contract is. This is the idea of contract recycling. It's about the idea of selling those in the money contracts or close to the money, close to the strike price contracts because they're not going to be moving as well, and shifting to more out of the money contracts as the stock is holding your levels and capturing that entire move down. The drawdown of doing this, though, is that you're going to pay more in contracts and commissions. That there's a drawdown to everything. This is the drawdown. The drawdown is if you pay commissions, you're paying commissions on the entry and the exit. So you're going to be entering and exiting again and thus racking up commissions. But in my opinion, it's still worth it if the volatility is there because the contract percent-wise, a 3-4% difference is going to be substantial even on $3,000. Okay? So again, this trade, in my opinion, was one of my best trades I've taken in a while, but it wasn't because of some crazy strategy or crazy approach. It was simply just because we used EMAs to hold the trade for a lot longer than we normally would have. We held for our levels. We used a contract recycling approach, which allowed us to enhance our profitability in the end of the trade, and we're walking away with a big gain today. I hope you learned something from this video. Leave a comment if you guys have any questions. I will be in the comments for the next few hours answering questions about this trade, about EMAs in general, or about any sort of trading strategy or approach. Let me know in the comments what you guys think, and I'll see you guys all tomorrow morning. Bye, guys.